Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. Following the last two episodes where we discussed our macro and asset allocation outlook for 2022, this week we focus on the outlook for stock markets in the year ahead. For global equity markets, 2021 marked the third consecutive year of double-digit returns. However, drivers of returns were different across these 3 years. Whilst both 2019 and 2020 saw huge valuation expansion, earnings were stable in 2019 but fell in 2020. 2021 was however driven by earnings while valuation multiples contracted. In 2022, we estimate valuation multiples to fall further but earnings growth to remain strong. At the time of recording this podcast, institutional brokers estimate systems consensus estimates for 2022 earnings growth stood at circa 7% compared with an estimated 53% earnings growth during 2021. We believe there is a significant upside for earnings growth estimates for this year. However, the situation with valuations is going to be tricky in the year ahead. And here, valuation changes are likely to induce volatility and influence the returns during the year. The key driver of equity valuations will be the conduct of monetary policy in the US. This is in line with our macro and asset allocation thesis, which put the conduct of the central bank policy in the developed world, especially in the US, at the center of our investment strategy and outlook. Based on how the developed world central bank policies are likely to emerge over the course of the year, we present three different scenarios for equity markets. First scenario is our base case scenario, which enjoys the highest probability in our assessment. Here, the US Fed tightens its policy in line with the current market expectations, and the conduct of monetary policy remains appropriate for the evolution of the growth inflation mix. Market estimates of the terminal rate remain well anchored, helping valuation multiples to drift lower only gradually. Earnings growth, however, surprises to the upside by the end of the year. In this scenario, global equities in aggregate could post mid to higher single-digit returns. Our second scenario is the downside risk scenario, which has lower probability than our base case, but is still possible. Here, the Fed tightens too aggressively, and its policy turns inappropriate for the growth inflation mix, at least based on market perceptions. In response, market estimates of the terminal rate rise. Despite the earnings growth remaining considerable, valuation multiples could contract considerably and create a negative drag on overall returns. Our third scenario is one with upside risks but is the least probable of the three scenarios we have in mind. In this one, the US Fed surprises with easier policy in line with the moderating growth and abating inflation. Market estimates of the terminal rate remain stable, and against this backdrop, helped by stable to higher valuations and strong earnings growth, equity markets could post the fourth consecutive year of double-digit returns. As you can tell, the three scenarios present a wide range of outcomes and are reflective of the uncertainty that generally exists during the mid-cycle transitions. But as we have been saying, as the cycle matures into a new normal, uncertainty should start to diminish and provide a reasonably clear path for financial markets. However, for the next 12 months, keeping in mind these scenarios, we think it is reasonable to expect lower returns from stock markets. We don't mean to suggest negative returns, but lower positive returns compared to the extraordinary returns of the past 3 years. Under our downside risk scenario, equity markets could see a fall of 10 to 15%, but in our view, any such drawdown will remain buyable. As such, we stay neutral equities in our asset allocation. We expect volatility to rise over the next 12 months, and to navigate these volatile markets, diversification will remain important. Within the asset class, by geography, we maintain modest overweights in US, UK, and Asia, and remain underweight on Europe ex-UK and emerging markets outside Asia. By sector, we prefer industrials, information technology, and communication services. By styles and factors, we stick to our preference for large cap growth, and we play value in small caps. Dividend yielders are likely to shine as interest rates back up. We reiterate a strong focus on quality. Defensive attraction of low volatility segments is likely to shine through the next 12 to 18 months. For investment opportunities during 2022, the laggards of last year are worth watching. This would include Asian markets by geography, clean energy, education technology and healthcare technology by theme, and consumer staples and healthcare by sector. In the near term, as concerns of the Omicron variant subside, sectors like airlines, hospitality, and consumer services could perform very strongly. Thank you for listening to this podcast. We hope you found it useful. We would appreciate it if you can share it with a friend or a colleague. In case you would like to get more information on what was discussed on this podcast, please reach out to your contact at ADCB. Don't forget to watch this space for more episodes of this podcast discussing our 2022 outlook for various asset classes. My name is Kishore Muktinutalapati, and I will be back next week with more global investment insights.